and party improvement proposals. However, before we do either of those, we have our second guest speaker to present on a topic of interest. So many of you would know Andrew Downing, who was renominated this year for the position of Policy Development Officer, has put together a short presentation on cryptocurrency. So Andrew, would you like to take it away?
Sure, I will. It isn't strictly cryptocurrency, they're very related. I'm just going to share a thing here, and Mandrake, you said you could make this share come up in a nice way, yeah?
Yeah, I've got it all set, ready to go, so let's work out what happens once you enable the sharing.
Okay, share. You see that one? Go back into present. Talking about money, you see that one? Yeah.
I see, I just need to copy it over.
Okay. I just want to see what that looks like in the stream. So I have some idea what I'm talking to. It should be interesting. Stream in stream. I'm not seeing it there yet.
Because I've got to on video it.
Okay.
That's what it should look like.
Like that? Okay, that's not too bad.
Maybe not to drost it. So switch
If
it away
you...
so it doesn't drost.
Yeah, that's pretty good. I like that. All right, hang on. Here we go. Put it into presentation mode. That probably looks reasonable. Okay, so it's not strictly a cryptocurrency talk, although there's obviously overlap in that. So it's just the subject matter is talking about money. So we have relatively little economic policy overall at the moment. It's not entirely clear which area of thought we embrace. We have a few things going in that space. I mean, we have some policies around, obviously, the basic income as a negative income tax. We've got some things on land value tax. We've got a basic cryptocurrency policy. And it's not entirely clear which general economic disciplines we follow. And what I'm trying to do here today is not necessarily to present any specific policy. I'm trying to lay out sort of a framework for thinking about some things in this space, with a particular emphasis, I think, around the economics of the wealth inequality that people worry about, and its relationship to environmentalism, because I think those are probably two of the larger concerns in the population at large, particularly amongst the younger generations as they think about politics and economics. These are the things they care about. So, moving on. So, a few terms and ways of thinking about things. What is money? Money is a technology for communicating value between humans doing free trade. We negotiate through trade to decide on the values of things. We buy or sell things, and that's how we figure out the value of different things to us. Now, I made this little formula here where I said, look, value equals time times effort times some technology function over energy and resources. And if you thought about economics as it was a long time ago, when it was just, the sweat of your brow, it was pretty much just the time and effort part of that. But as soon as we harnessed a horse and started having a pull a plow for us or something, we were applying a bit of technology. And today, the technology factor part of that is coming to dominate the whole value proposition. And long term, we end up heading towards this kind of a post-scarcity thing where the energy and resources are essentially free, and the time and effort portions or the effort portion becomes smaller and smaller as we need less and less human involvement to actually produce value. And just in case it wasn't obvious, the notion of some things having inherent value is I think a bit of a nonsense. All value is subjective. We figure out the value that we think a thing has by negotiation between us. Now, since we have money representing this value, then the numeric value attached to money relative to the actual value it can get you in the world varies over time. And when your money becomes worth less over time, we call that inflation. When your money becomes worth more over time, we call that deflation. And that's because the two aren't well tied. And so, and monetary policy affects all that sort of stuff. Now, there's some other sides to that, but we'll get to that in just a moment. The technology factor is the big one I wanted to get into in here, because I think this is very central to where the Pirate Party position on economics and monetary policy in general could be somewhat different. We're much more technology-centric. We have a lot of technology understanding, knowledgeable people, and so we can work that space perhaps better than a lot of other competing parties. So technology is a value multiplier over time, and we are on a sharp technology ramp. So your future time and energy should produce more value than it does today. But the problem there is that the gains that should be socialized from that are essentially stolen from you in the form of inflation. So inflation really is a hidden tax. It means if you have money, you've been saving your money up, it's getting progressively worth less and less over time. Now, I should interject a little comment there about the way the whole inflation thing works. Most people conflate the idea of inflation with the CPI that the government publishes. Trouble is, that's kind of a bit of a nonsense. That's their little basket of goods. But in fact, inflation operates independently and differently against almost every different commodity. And the situation we've been having lately, at least especially over the last sort of few decades, has been that mostly we've had asset inflation, and which is to say, the prices of land, prices of shares, the prices, value of companies, metals, commodities like that, those sorts of things are all going up rapidly in value, or in sort of numeric monetary value. Whereas the sort of commodities that are measured by the CPI tend to be things that are held relatively stable, and they exhibit typically under 2% inflation. So there's not much change going on there, and everybody thinks that therefore, oh, look, the cost of living didn't really go up. But in fact, the largest chunk, the largest single factor in most people's lives is the price of a house and land, and that's not included. So we see the effect where, in fact, back in, say, 1990 or something, it was the average person needed to borrow somewhere around 1.5 to 2 times their annual salary to have a roof over their head and some land to stand on. Now it's closer to 6 times, and so you need 2 incomes to do it. You can't say that wasn't inflation. It was. It's just asset inflation. It's not covered in the CPI. This is something that John picked up and talked about on his radio show recently. Now, the thing about the way that the technology influences things, though, is it advances like an evolutionary process. And there's a funny effect here, which is to say you have long periods of time where it's relatively stable, there's not a lot of changing, and then all of a sudden the convergence of a bunch of things come together and woof, everything changes. Like, we suddenly had the internet, suddenly mobile phones just changed the way everybody communicated. Social media did similar things. There's always these convergence points. Historically, they were bigger events that took longer to happen. There were things like we had a printing press. It took a while to get around. Decades going on, centuries before that made a big splash, because we had to train a whole population to read, right? Similarly, we had industrial and agricultural revolutions. Those things took decades going on, centuries to really roll out. But now these things are accelerating and compounding, moving forward. And so what we see is that the modern sort of information network revolution is driving machine intelligence, biotech, decentralized cryptocurrency-based economics, fully automated bespoke manufacturing, and there's an energy revolution going on as well with storage and renewables, and pretty soon we should have some fusion energy generation going on. I see companies already lining up to actually turn that into production, and obviously quantum computing is another big one. Now, these things produce step changes, and when you get these step changes, it really ramps up that formula I was showing earlier, where that technological function across energy and resources suddenly has a big, big change. And the effect of technology on the value of things is deflationary. It essentially means that the cost of everything should get lower. You should get more for less. That's why we do technology. We do technology so we get more for less. That's why, right? And so it is inherently deflationary. But we have this slight problem, which is that the monetary system we're operating with is inherently inflationary. It's modeled the opposite way around. So, if we ever look like we're not going to have inflation, then everybody goes into a frenzy trying to stimulate the economy to make sure inflation keeps happening, because otherwise debts go bad and so on. It turns into a real mess, and you have recessions and depressions and so on. So they're having to actually do some pretty crazy things, and we'll get to that in just a moment. But to get some idea of how this technological ramp is continuing. It's a lot of it's really under the covers, driven by this Moore's law in computing, where we essentially double the computing power we have available for a given price. Forget about clock speeds or chip size or transistors or all other crap. It's the cost of how much bang for our buck do we get in computing is the issue. Because that's the thing that has the social impact. That's the thing that has the impact on all our other industries. And it's easy to dismiss this stuff as being simply look, computer go faster. Yeah, great. No, not great. That's not it. The computer goes faster and the networks go faster, and suddenly that's the thing that's driving all of our other major industry. Biotech does not work without massively parallel computation. Doesn't work. Yeah, artificial intelligence doesn't work without this. All these other sort of other industries, and manufacturing. Modern manufacturing is all about being able to fully automate things, which means robotics, which means machine learning, which means computing. Every industry, even down to silly things. You want to make chairs and sell them to the world? There's going to be a design system that's all in infotech somewhere, and there's going to be a factory somewhere. And if you want your chairs to be cheaper than everybody else's, it's going to have to be a fully automated manufacturing system that just spews these things out and does it without human interaction. That's going to be the thing that makes it win. So it's computing every damn time. And if you look at this curve, actually, if you just sort of blur out and look at that curve a little bit, this is actually on a log chart here, right? And notice that even with a log chart, the line is actually ever so slightly vertical, ever so slightly an upward curve. So, in fact, it's not just accelerating. Technology is actually a jerk. Technology is a jerk, being the third derivative of change over time. So, this is what's driving it all now. So what happens there? So you may be wondering, why are the house prices going through the roof? How does it relate to that technology stuff? And why is your house? Even in the middle of a pandemic, the price of houses went up dramatically. We had the shares in a giant bubble. Where students are laden with debt, and wealth inequality seems to be getting out of control. And I think the core issue that's driving this is in fact this technological surge that we're having here, because it produces deflation, and to keep things inflationary, they have to just keep issuing more currency. And that's what we're seeing. That's why there's this meme out there about the whole money printer go burr thing, right? The US has issued something well over 20% of all US dollars that have ever been issued were issued in the last year or so, right? It's crazy. And Australia is planning to keep up with that. Our budget, and a Liberal government, is expected to be have us $1.1 trillion in debt by the end of their current budget cycle. So that's a huge dollar issuance. Part of the problem with this, though, is that the central banks who are trying to do this, who are trying to orchestrate this, have run into a problem, which is that they can't actually issue enough more money. They can make it available to the commercial banks, but the banks can't lend it or won't lend it because the market looks too risky. They don't want to risk it because if they lend it, they get free money from the central bank, and then if they want to lend it out to somebody, they want to know it's going to get paid back. But everything looks too risky. The industry is in the shitter at the moment, so they don't want to lend it. And in fact, in Australia, the central bank, the Reserve Bank in Australia, put forward, I think it was like $400 billion available to the banks for them to do lending, and they eased the reserve conditions to make it easier for the banks to lend. But the banks are giving most of it back because they don't want to lend it. So that's an interesting situation. And when you get down to this point of having these zero or even negative rates, we're heading toward negative rates. They've been flagging that they might actually do that in Australia shortly. That means that people who are perhaps, they've saved up all their life and they've got they've retired now and they've got an investment portfolio or banking or whatever, money in the bank or whatever, and they're hoping to live off the interest. Well, they got none. It's they have no income. And so this drops spending as well, makes it even worse. So there's some real problems there. And if you want to know where that money's going, this is where it's going. Big bubbles. This is the Nasdaq. This is the Nasdaq plotted out, the aggregate value of the Nasdaq exchange over the last 20, 30 years or something, actually longer than that. This little peak that you can perhaps see in the middle here, this little spike, that was the dot-com bubble. Yeah, and you can see how that spiked up around 2000 and then dropped down just across to the right a little bit further there, around about 2008. There's a sudden little dip there. That was the global financial crisis. Well, take a look over on the right here. This is where we are today. Well, do you think that's not a bubble? That's a bubble. That's the biggest freaking bubble the world's ever seen, and it's a monetary bubble. It's basically it's the governments issuing vast amounts of cash, vast amounts of currency to stimulate the economy, endlessly trying to prevent any kind of drawback or recession. And they've painted themselves into a corner. Right now, if you were to just project that forward, I would estimate that the really likely actual value that you could attribute to it now, if it wasn't for all that bubbleness, would maybe 4,000, maybe down here somewhere. Currently it's 14,000. That thing looks like it's ripe for a crash in the order of 70%. I could see a 70% stock market crash coming up in the not too distant future. And I mean, every one of these little jaggies here, every time these little things drop like that, usually the event that presaged that was basically the US Fed or anybody connected with the Treasury making any suggestion that there would be a rise in interest rates. And everybody panics and it dips for a bit, and then they go, oh, no, we didn't mean it, and it all goes back up again. So that's the game they've been playing, and there are crazy, ridiculous evaluations going on out there now. Then the governments also take advantage of this. There's actually you have a look at usdebttalk.org sometime. You can see what's happening to the US government in terms of their budgetary things. They currently have a national debt that's about $28.5 trillion. And if you think for just a moment, you'll realize that the only way they can sustain that is if they have the currently near zero interest rates. If they try to slow down the inflationary effect of all this money printing by raising rates to even like 5%, what it ends up meaning is that half of their annual budget will be in interest payments, which means they need to borrow even more. So they painted themselves into a corner. They can't back away from this without creating a massive crash or going into some kind of hyperinflation. It's a crazy, crazy situation, but they really painted themselves into a corner here. And if you think that's a scary figure, take it down the bottom right here. You see this US unfunded liabilities. They basically have $154 trillion in terms of liabilities, things that they are liable to pay for in the future, but for which they have no sub-funds set aside. So that's rather extraordinary. I don't see how that ends up working in the long term. And sure, I'm talking about the US instead of Australia there, but we're in a fairly similar situation in many ways. We actually effectively have to keep chasing this. There is the international markets today are so bound together in bizarre ways, and their monetary systems are bound together sort of bizarrely. I mean, we want to maintain our balance of trade. We want to make sure that we can sell our stuff to other countries. And so we need to make our products cheaper. And the way we make our products cheaper is we issue more currency to devalue our own dollar relative to everybody else. Everyone else is doing the same thing, including the US. And so all of the countries in the world are devaluing their own currencies. And in the process, of doing that, they have asset price inflation, and they have basically a greater increase in the wealth disparity in their own country. They're making their own people poorer, and their working people poorer, and their asset owning class richer. And that's happening globally as a direct consequence of the inflationary nature of money versus technology. Problem is, though, say it's a trap. Oh. So I talked ahead of myself there. Whoops! I should have thrown that one out there. Whoops! I haven't rehearsed this enough. I was saying before, if they even increased it to 5% as a rates, historically, to prevent inflation when it gets carried away, you need much higher rates than 5%. But if they went to like 10%, then the interest would be the whole of their budget. So they can't do it. The whole business of issuing more currency like this, it's rather like getting some new credit cards to pay off the debt on your old credit cards. It's like it's a bad practice. You'd know better. Don't do that, right? So the problem here is, as I say, history doesn't so much repeat itself, but it rhymes. Yeah. We actually saw the same situation back at the beginning of the 20th century. We had there the culmination of the agricultural and industrial revolutions, and the countries around, particularly around the Western world that sort of traded with each other, all experienced these same set of symptoms. They actually were devaluing their own currencies so they could manage balance of trades between each other. So you get these sort of currency wars, they call it. Currency wars lead into tariff wars, trade wars, where you start taxing other people's imports and other countries' imports and so on. And then eventually that ends up escalating, and people start seeing that as being like an economic attack against them, and then they get really antsy at each other, and then it turns into hot wars. And that was pretty much what happened back around then. They went through practices like confiscating all of the gold. We saw that out of the US. We get the sort of the hyperinflation of Weimar Germany. We get the Great Depression in America. We've got 2 world wars. All this stuff is what happens when everybody's monetary systems find themselves in this great conflict. It expresses itself in some horrible ways out in the world, but it comes down to people trying to live together and work together with monetary systems that actually work, and some kind of fair system of value that people can agree with and have consensus around and work together. We can't do that this time. It's not an option. So we need a better answer. And the flip side of this, the other major, there's the environmental connection to this as well. If you imagine that an inflationary currency and its need to grow all the time, when you keep inflating, like we have to actually keep on growing in the economy to keep up with the inflation. We need to grow at least at the rate that the inflation says it's going up. And it's not too hard to figure out that an economy that must, by design, by definition, grow forever is utterly incompatible with environmentalism. you can't have a future good environmental situation if your economic growth must continue forever in a world of finite resources. These things don't work together. So we need to be switching to an economics that supports a steady state, because we're going to have a plateau in the population. We've got a limitation in resources. So ultimately, we need an economic model that does not require forever growth. If we don't come up with something better, then what we get stuck with is the default, which is to say that the central banks are keen on, let's say most of the central banks of the world are keen on having central bank digital currencies. Now, in some ways, they think of this as being an answer to several different problems that they, in their perception at least. One of the problems is that there's a black market and you can't tax that. That happens in cash. So having a central bank digital currency and replacing cash with that means that they think they can eliminate the black market. Well, they can't. People will just find other ways to trade in the black market. Not the least of which is probably something like Monero or Zcash or something like this. Pick your currency, right? But the other big reason that the central banks want to do their digital currencies, or there's also add efficiency to that list, but the other big reason is that it's a way for them to get over this issue about the commercial banks' unwillingness to lend money out into the world as money supply into the economy in the face of high risk. And so they simply can't get enough money out into the economy to meet what they want to do. If the central banks have their own central bank digital currency, then everybody, you, me, the whole population, companies, everybody has a direct account with a central bank. They're not just dealing with commercial banks anymore, they're dealing with everybody. When they deal with everybody like this, the central bank doesn't have an organization like a commercial bank who cares about risk between them and the end people. So now we get this situation where actually the US federal banks have just done this, where they've actually opened up their dealings from the central banks to a variety of financial institutions that are non-banking organizations who couldn't get loans through commercial banks, and now they're being lent money directly from the central banks, currently, initially, just to the tune of about $1 trillion worth. That's just been announced over the last few days. But that's going to expand. So commercial banks are being cut out of the flow here, and we're all going to deal directly with the central banks, apparently. This is a bad idea on lots of other fronts. I mean, for one, it's the most powerful tool ever for a central government authoritarian control over everything. They get to decide every damn thing you can and cannot spend money on. They can decide that, yeah, well, look, we gave you this money, you can only pay these things for it. It's like it's like some of the things that the Liberal government tried in Australia for unemployed people, excepting now you could do it to the whole population. China is obviously very keen on this. They're already rolling theirs out, and they're connecting it to their social credit score system. There's a lot of talk about behavioral economics, which is to say they want to reward different kinds of spending behavior. They might go, well, look, we see you buying alcohol with your money. We'll make that worse for you in some way or another. They'll just make things more or less expensive, depending, right? They can penalize you or reward you based on what they think is good. It's centrally managed economics because we're giving them the power if we let them do this. So it's still destined to grow forever and destroy the economy because it's still a fiat-based inflationary currency. It's still going to be driving wealth inequality. They're just ramping up the currency they're issuing to an even greater degree, and they're doing it in even riskier conditions. Only they don't care if the risk goes bad because they can create as much money as they like because they're the central bank and they poofed it out nothing in the first place. Now, it's true the rest of us, whenever they do that, they just devalue all of our savings and create more wealth inequality and help destroy the environment. So it's a mess. I don't see this as being a great idea the way it's going, but any central bank that doesn't play this game is going to be at a disadvantage against all the other ones that do. The urgency with which this is now needed to be done appears to be ramping up in the US now. The US is going, yeah, we're going to have our own CBDC. Australia has been on the bandwagon for this for years now. They've been planning it. You may notice all the changes we've had with Australia trying to phase out cash. A lot of stuff like that going on. So watch out for that. So we need a better monetary system. I'm nearly in now. It needs to be decentralized because who would you trust to control the global economy? It needs to be deflationary, so they naturally share the technological gains because the value of your money will increase over time as efficiency goes up with technology. It needs to be programmable and open source so we can all see how it works and choose to participate. It needs to allow permissionless innovation. Anybody should be able to innovate on this front on a global scale, and they should not have to ask for some permission to do so from some central authority. It needs to be global and boundary-free, but anti-monopoly. It needs to emphasize efficiency over forever growth, which a deflationary currency tends to do. It needs to be taxed on the basis of our shared and limited resources. We want to tax resources, not transactions, not trading, not income, not work. We want to tax the resources because they are the scarce and limited resources that governments can, within the bounds of their own geographical nations, have some control over. We can tax the stuff that's being dug out of the ground. We can tax the trees. We can tax the farming. We can tax everything that's physical, and we don't need to limit everybody's freedom to do so. So that's the summary of what I think we ultimately need. The details of how we should do that is something I want to work on over the next year. But to wrap it up, we have two choices, two futures we can choose here. We can have the Star Trek future, where the price of everything converges on zero, where it's a post-scarcity economy, and everyone shares in it fairly equally, or we can have the Star Wars future where all the value flows upwards to a few elites, which is where we're heading at the moment. That's wealth inequality. That's where that leads. So take your choice. Pick one of the above. I know which one I'd prefer, but I thought the analogy worked well. Thanks. That's the end of that. I'm not sure if anybody had questions.
Just had
Thank you very much,
one
Andrew.
in chat here from Jed. The trouble with predicting stock market crashes is that the stock market can remain irrational for longer than you can remain solvent.
I know where that quote comes from. I know exactly where that quote comes from.
Other than that, very interesting stuff.
Okay. Do you want? I should probably take down that presentation, shouldn't I?
Yeah, how do I stop sharing that?
First five.
Just to comment on the Star Trek and Star Wars analogy, I use a similar analogy of the same to describe political ideologies, because in Star Wars, the good guys are the rebels fighting against the big guys, and in Star Trek, the good guys are the big alliance, and they're trying to get rid of any rebel factions. So they're almost bipolar opposites.
Yeah, that's why I thought that worked as an analogy there.
Yeah.
The rebels are pirates, right? Rebel scum.
And the National Council is the Jedi Council, right?
I guess so. Yeah.
Yeah, I think so.
And
We have a couple more questions in chat.
What are we looking at here?
sorry, Alex asked what happens when you put that Nasdaq graph on a log scale.
I think that would actually look slightly more accelerationary than what jerky than straight line. It's actually accelerating upwards as well, but it's driven by monetary value. If you let's say monetary issuance, if you look at things like whenever there's any threat of stopping the things like the stimulus and so on, that immediately causes it to drop. You get some other really bizarre behaviors. You get companies doing things like taking the 0% loans to go and buy back a lot of their own shares, so that the share value goes up because their own shares are now more scarce. So they artificially inflate their own share prices by bizarre practices like that, because money being that cheap, it distorts all pricing signals. You get weird things like, Tesla it's a great company. Tesla does some good things, but they are not worth more than all the other car companies put together. That's nonsense, right? Apple did not do anything that would actually double their value in the last year. That's nonsense. I mean, they're a good company. They produce some good products, but they didn't double their value in terms of their underlying value of the company in the last year. It did not happen, but the share price suggests it did. So there's some pretty peculiar things. This monetary policy is wildly distorting all of the pricing signals, and so we're seeing these very ballooning sort of behaviors and distortions of normal market behaviors. You get sort of 200 to 1 price to earnings ratios and things like this, where it's like this. It would take another 200 years to get the return the share price suggests you should be getting, because the company can't earn at that rate because they don't have any capacity to do that. It's turning into gambling. I'd suggest that also has something to do with why over in in cryptocurrency land we see some very bizarre speculation on pure meme-based coins, right? Dogecoin and things like this. It has no meaningful underlying functionality. There's no particular reason anybody should be supporting the project. But what we understand is that there's just a gambling mentality when people don't see a way to make a gain through actual value production, right? When the price signals are also distorted, and when you can just act as a collective to bet on a thing, it turns into a game of betting.
Just a couple more, a comment and a question. Alex says absolutely it'll look less dramatic with regards to the Nasdaq being on the logarithm. It's just that even garden variety inflation can make a dramatic linear scale graph.
Yeah. Not like that one though.
And a question from Jed. Any thoughts about how cryptocurrency seems to exchange ever-increasing inflation for ever-increasing computation requirements to keep up?
The increasing computation requirements don't relate to the inflation or whatever. They relate to the difficulty factor, which is really more about how many participants there are and so on, and that's only in proof of work. There's a whole separate story around proof of work that I could tell, but it's somewhat more extensive than we probably have time for right now. It's curious if you just very simply though, if you looked at say gold has historically been the basis for store of value over time. And the reason everybody globally and independently converged on gold for that purpose was that it is A, scarce, and B, it takes a lot of work to actually acquire it. And that work and scarcity is very, very hard to get around. And so Bitcoin in particular, with its proof of work, is an implementation of that. It is saying, look, you can't acquire this without doing a lot of work, and it is scarce, and there is not going to be more of it. It's more so, it does gold better than gold in terms of any algorithmic measure of it. By comparison, things like, say, what goes on in Ethereum, where they're actually heading towards proof of work, which is a different algorithm based around, I hold a lot of this and I don't want to lose it, therefore I should validate your transactions correctly, otherwise I will lose my stake. That's a short-term thing that says, in the here and now, right here and now, I'm putting my money on the line, and that's why you should trust me to do this. It really, but I could take that money away at a moment's notice and say, well, look, today I'm validating your transactions and you should trust me. Tomorrow, I could just let this go. It's like a what's the right sort of comparison here? One, if you do that, you go down the proof of work route, you've got skin in the game, right? You actually spent the value on all that computation, on doing that work to acquire the thing. It's sunk value. And so it retains its value, which makes it more suitable as a store of value over long time frames. Whereas the proof of stake is a short-term, trust me now because I have something to lose now, but tomorrow, who knows? Yeah, the different modes of thinking. Proof of work is equivalent to the gold idea. So they're both valid. They're both valid and useful, but they have different purposes. And having a solid long-term store of value is actually really important. It's the way we manage to effectively trade with our own future. It's the way we say, I want to acquire some value now that I know I will be able to use into the future. That in 10 years' time, I'll be able to use the value that I acquired today and know that it won't all be frittered away. You can't do that with something that isn't grounded in work like that. So there's some weird considerations there. I'll shut up now. But...
Yeah, thanks, Andrew.
Can I just say a quote that was, I think, simplified of Andrew's, and saying the increasing environmental impact of energy consumption of something like Bitcoin, that is not a bug. That is a feature, and a very damn good one of that.
It is actually a feature, yes. You just went silent.
Did I? Shouldn't
have. You're back.
I think you've, I think you got it out. I was specifically referring to the energy resource requirements in running all of those miners as a specific subset of other issues in crypto.
As Andrew was saying, so not my point. It's not a bug; it's a feature. And besides, a lot of those miners, they're looking at going, wait, it takes so much to get everything, so we need to look at stuff to where it is cheap and where it is good. For example, doing like a lot of those big projects for energy storage. What's a good thing is often base load. A good thing for doing that? Crypto mining.
Yeah, there are some weird uses for it, and certainly that whole industry that drives that stuff is having a big swing in the direction of renewables as the source for these things, and that's sort of certainly helping them. I know good old Elon's influence on that actually seems to have created quite a bit of inertia toward them heading in that direction. So yeah, they're using a lot more renewables now, and they're playing a lot more interesting games like trying to incent the generation of new renewable energy generation by actually funding it, because you create a new solar system out in the desert somewhere, and what's going to pay for that? Well, look, you put up a little crypto mining thing right next to it, and you essentially manage to pay for that and the storage to turn it into a 24-hour thing. And then the rest of the population catches up and then starts using that, and then you move on to the next one. So because it's mobile, it's essentially a use of power that generates instantaneous value that you can actually relocate with ease. So it's a funny game. There's a lot of fairly dynamic considerations in terms of how this rolls out in the world. But again, it's not the only answer out there. It's a part of a much broader answer. So I don't want to suggest that, look, Bitcoin is the be-all and end-all of everything. It's not. It's one piece of a larger puzzle.
And another one from Alex. I'd like a currency that costs less than the order of $10 per transaction. What do I do?
Well, you could try doing Bitcoin transactions with the level 2 Lightning Network, where transactions happen sub-second and cost less than 1 cent. That's what's going on in El Salvador. Basically, if you want to think about, and in the case of Bitcoin there, the level 1, the layer 1 network is more like the settlement layer. That's how it's emerging as. So imagine, Visa and credit cards and banks, they have their own settlement layers where they settle the exchange between each other. They do that it takes them up to a week to get final settlement. Bitcoin achieves final settlement every 10 minutes and costs maybe, like you say, about $10 or something like this, right, to achieve final settlement like that. Meanwhile, you put the layer 2 network on top of that, known as the Lightning Network, and you have transactions that are happening sub-second and they're costing less than a cent. So that's the equivalent of actually swiping your Visa card around the place. That's what the answer looks like. But that's just one answer. That's the Bitcoin answer. But it isn't necessarily the right answer to all problems. It's a partial answer to a whole raft of problems that need thinking about. Did that answer your question, Alex?
All right, Sean's bumped his question here from earlier. I must have missed that. If trade is untaxed and savings grow continuously in value, does this mean that massive industrial scale, let me get that, massive industrial scale arbitrage would become essentially an untaxable source of massive wealth? Do we simply expect tax costs to be passed on and eventually flow upwards from the resource usage to this untaxable stockpile of wealth?
Wealth ultimately derives from the energy and resources that you're consuming, and so you put the tax on the resources, and that at a country level that you pay for the public infrastructure and social security and all the sorts of things that you want like that. And that should deal with that. But yes, there is arbitrage, but arbitrage should slowly dissipate down to the point of nothing, because what we're actually seeing is the convergence of the markets. Arbitrage is usually where you are looking at two different prices. You're seeing a price over here and a price over there, and you use the difference to make a profit. What we're actually seeing is the emergence of fully decentralized markets. That's DeFi, decentralized finance. And what's happening in that space is that all of the individual decentralized markets that have been emerging are actually being bridged. So you end up with one giant global spanning market with lots of different access points. And in which case there essentially is no arbitrage opportunity within that, because it's one giant pricing market on a global scale. So I think arbitrage should get harder and harder to do over time.
Certainly makes sense. If you don't have at least partially separated markets for the same commodities, then there won't be so much potential.
Yeah, one of the largest areas of growth in the last year or so of the cryptocurrency world has been decentralized finance, which is all smart contract-based trading systems and loans and investments and insurance and whatever else you might want to have in that space. And those guys are just completely reinventing how to have things like exchanges. An exchange where there is no central organization, where there's just a market that people participate in, where the liquidity that's available in that market is provided by liquidity stakers. Like, I could come along and go, well, I see a lot of people want to trade in between Bitcoin and Ethereum, say, so I provide some of each, and I provide that as a liquidity thing into this decentralized market, and I get to make a small margin on my capital there by investing it that way, and so I get a slice of the trading fees for having put up the liquidity like that, and then I can draw that back out at any given time. And so, rather than a central institution profiting from your trading, instead anybody can participate and gain some of the value that is acquired through provision of the trading mechanisms. It's very, very open and very, very fair, I think. And as Alex says there, yes, tax-wise, I am arguing for an eventual shift to resource and consumption taxes. And we were already a little bit down that path. I mean, certainly property, we've already talked about land taxes, but minerals, yeah. Carbon taxes, yeah. All of the things that incur a tax into our common base, the commons, even as a principle base, that actually works quite well. The idea that you can steal my labour is a bit harsh, and that's what income tax is. So I don't know quite how ethically we justify that particular kind of a tax. But the resource taxes, you can look at it as, well, as a starting point, everything in the way of resources, the commons or whatever, is owned collectively by everybody. So if you're going to take some of that for your exclusive use, then you should recompense everybody else for having taken it away from them. And that's the tax. Same with land tax. If you're going to take a piece of land and use it exclusively for your own purposes, and you're going to exclude everybody else from it, then you should compensate everybody else in the country for being denied access to that piece of land. This makes I think, for a morally sound basis of taxation, as opposed to stealing my labour.
I'd like to step in here. We are at just about 3 p.m, but we still do have some other business to jump into. So I know there are still a couple of questions.
Any further questions for Andrew?
There are actually still, by the looks of it, a couple of questions sitting on there, but as it's just coming to 3 p.m, I'd like to cut that short there,
Yeah.
so we can
take those offline. Can I drop off to the channel now?
Yes,
Yep, thank you very much, Andrew.
Okay.
The presentation is very well put together, and there's a lot of stuff to think about there. And certainly our economic policy has been, it's always felt lacking for a long time. Sure, we're looking at tax reform and social security reform.
Could we maybe take a 10-minute break before we get back to the remaining PMs?
Would you like to put a motion for that?